How much money are you going to owe in taxes when you sell your home? This is Ron Wojciechowski for the Black Hole of Real Estate. And the first thing I want to say is I'm not a CPA. I am not a tax professional. I'm not licensed. I'm not trained. So you should get your own advice. But I've learned a few things along the way. And one of them is some of the tax treatment things that we notice at closing. Now, when you sell your home, there's going to be something due, like for closing costs and things like that. But then you'll get, one of those 1099-S forms from the closing company sometimes, and you got to pay that tax due if it's actually due. So this is where you have a little bit of knowledge up front. Definitely talk to someone who either does your taxes or you do, but be aware of this piece. So let's suppose that you bought the home, I don't know, 10, 12 years ago, maybe 2015, and you've owned the home for 10 or 11 or 12 years. Back then you paid $200,000 for it. And then now, maybe you're selling it for $500,000, which on the surface looks like a $300,000 gain. And what are the taxes on $300,000? Well, if it was ordinary income tax, like within the first year, like you bought it and sold it in less than a year, that's probably where it would go. But in this case, let's suppose for a minute that it was a primary residence. So if you owned it just individually, on your taxes, your federal taxes, you're going to have that $250,000 exemption of the profit. So if you pay $200,000 and you're exempting $250,000, that's $450,000. So now there's $50,000 left in the middle. Now there's also something called a cost basis, and again, seek professional help, accounting help, anyways, or both. But you may have things that will increase the cost basis. And let's just suppose for a minute that you paid $200,000, but then you did some work. Maybe you added a pool, added some value, added a garage, made some changes where the square footage is now increased to the property. Anything that could be considered a capital improvement would raise the cost basis. And let's just suppose that you put $100,000 into it that qualified under cost basis. You paid $200,000. You added another $100,000 to it, it's $300,000. So now, if you sold it at $500,000, your taxable event might be $200,000. But with the exception in place, you may not owe any tax. Now, keep in mind that there are times where properties shift over to investment property. So now you've got to look at this 24 out of 60 month rule, which is again alluding to what I just mentioned, for the exemption. So if you lived at home for 24 of the last 60 months, then you could very well also qualify for the same exemption. But if you lived in it for like a year or two and then rented it for 10, it's probably going to flip over and be treated as an investment property, and you may very well have been depreciating, at a rapid rate in order to get some tax benefits. That could get recaptured, and that's where things can get a little tricky, and that's why you need that professional help to do this. Now, if there was two owners to the property and you filed the exemption and you both could do that, well, now you're going to be able to exempt up to $500,000 of profit. So a lot of married couples that buy properties that go up a lot in value over time can avoid most of the taxes if they've lived in it as a primary residence and before the closing definitely lived in it for 24 out of 60 months. So basically 2 out of 5 years is what we're talking about. Now, I've given you a lot of numbers and a few facts along the way, but I would also let you know that once you've owned the property for more than a year, if you owe some tax, it might turn into what is right now long-term capital gains, and that would be taxed at right now 15%. So all of a sudden, if your ordinary tax rate, and again this applies if you bought it and sold it within a year, like you flipped it or something like that. If your tax rate was 25 or 30% because you had a really big income, well then you're going to owe tax. If you made $100,000 and you're in 25% tax bracket, that's $25,000 in taxes owed. Now, if you own it for a year and a day, so long-term capital gains that goes down to 15, maybe it's a $15,000 tax. So it's a pretty big tax savings. If you're an investor or you're flipping and you're pretty close to a year, by delaying it, the sale beyond a year, that might actually help you tax-wise. So, that's one tidbit for you. It's one thing to look at. This can get super easy or super hard really, really fast. So when you sell a property, and you're at the closing, they talk about your exemptions and how you're taking title and filing things. Give a little extra care to making sure that you get it right from the beginning so you don't have to pay to change it down the road. And definitely, if you're looking at selling and you've maybe not lived in the property for a while, maybe take a look and see, do I qualify for living at 24 to the last 60 months? Because that might save you a lot of money when it comes to taxes, and it might give you the proverbial wiggle room. You might take a little less in the sales price, but get a lot back on the tax treatment side of things. And that's why I want to get this video out there, that a lot of people have owned homes for 10 plus years and they're getting ready to sell. Starting with the end in mind, if we knew there was going to be some tax consequence, wouldn't we want to minimize that, or at least know in advance what we're getting ourselves into? Chances are, if you've owned it and you've homesteaded it and it's been your primary residence, hey, you might not owe any tax, and that would be cool. All right, if you got questions, definitely drop those below. And in the meantime, hey, how about hit a like? How about a subscribe? Definitely rate and review us. And by the way, 5 stars is passing, 4 is failing around here. Let's do the 5 stars. This is Ron Weiss-Zakarski for the Black Hole of Real Estate.